There is a very big shift going on right now in the stock market. No, it's not a crash. It's even bigger than that. And this shift is going to affect everyone. There's literally going to be nowhere to hide. I'm going to go into exactly what it is and what you can do to prepare. All right, guys. So I want to talk about what this shift is, why it's so big, why it's bigger in some ways than, God, people overuse the word crash. I do my best to not use that word, but why it's even bigger than probably a crash, because it's not going to be a crash. It's going to be something even bigger. So I want to jump over to the price charts and show you specifically what the shift is, what's going on, what's behind the shift. And then number 3, why it matters to you, whether you're 70 years old or 37 years old. So let's jump over to the price charts and talk about what this shift is. Okay, so there is this ginormous shift going on. On the screen here, you see one black squiggly line. It's a relative price chart. So this is showing you growth stocks, domestic US growth stocks relative to value stocks. So if the black line is going higher, that means growth is outperforming value. Well, value, or I should say it differently, growth has just broken down. There was kind of this support where growth was doing okay, it was going sideways, but it has broken down. And that is a big shift, right? If you think about what growth stocks are historically, or at least since 2009, that's been tech stocks, it's been big stocks. But now growth stocks are underperforming noticeably relative to value stocks. So I believe, and the market believes, that's what's most important, not what I believe, but what I'm noticing in all these price charts over and over and over again, and we're going to look at them, is the leadership has gone from growth stocks to value stocks. And we're going to talk about how this looks. So that's the first big shift, that there's this big shift going on. Now, there's all these different ways that we can measure this. One is growth versus value. But another big one is US domestic versus emerging markets. And you can see here, I'll put it on here so you can see it there, that there's kind of this false breakout. So we're looking at a relative price chart. If the line is going higher, that means US domestic is outperforming emerging market. And it broke above this big horizontal support, broke above it, but couldn't sustain above it, and it's now below it. And if you look over to the right here, you can see that the line wants to get back above. If it doesn't and it turns back down, that means emerging market is reestablishing or continuing to reestablish its strength. And so another shift that's going on is US domestic has been beating everything since 2009. It's been beating emerging markets. It's been beating international developed. And then let me just show you another one here. This is US domestic versus all world ex-US. And you see the same thing here. So this is, if the line is going higher, that means US domestic is beating the rest of the world. If the line is falling, that means the US is now underperforming the rest of the world. Both can still be going higher. Just same thing with growth. Growth can be going higher, but it's just that value is going higher and faster and accelerating and is stronger than growth. Same thing here with US domestic versus international and US domestic versus emerging markets. So there's kind of a play going on right now that can the US get back up on its feet? So it'll be interesting, but it looks like there's a pretty strong shift or pivot between US domestic being the dominant location, and that has it is moving to international, both international developed and emerging market. So that's the second big shift. The next one that's happening is mega, very large to very small. So this price chart is comparing the Dow Jones 30 ginormous stocks relative to the small stocks in the US stock market. And if the line is falling, that means mega caps are underperforming small caps. And you can see the breakdown clearly happened, clearly broke down, and is accelerating. You can even see it didn't even stop right around here, which if this price chart was to stop falling, it should have happened between those two blue lines, but it just went right through it. So the next big shift is the big stocks are losing, have lost their leadership to the smallest stocks. And if I put in literally the smallest of the smallest, that IJR is small cap, I can put micro cap in and it looks even worse for mega cap. I mean, here's the Dow Jones relative to micro cap. So the micro caps are even smaller than the small caps. And you can see that is a pretty pronounced breakdown. So third theme is the mega cap stocks have lost leadership to the smallest, or the biggest stocks have lost leadership to the smallest stocks. Okay, and the next one we can call this new versus old, right? There's many different ways we can call this, but tech is now noticeably underperforming to financials. Financials? I mean, financials have been like dead and done for literally 10 or 20 years. And now financials have broken out. Now, I know that's not, I say broken out and you see a line falling. If the line is going higher, okay, if the line is going higher, that means technology stocks are outperforming financial stocks. But you can look here and say like, that's not the case anymore. That stopped last August and it is accelerating to the downside. So you could call this shift tech to financials, but I think of it more of new companies versus old left for dead companies. We could do the same thing for the other left for dead sector, which is energy. So you look here, energy was kind of, so I don't get ahead of myself. What you're looking at here is if the line is going higher, that means technology is outperforming energy. And you can see that it's either happened, past tense, or happening, that there's this huge shift going from tech stocks to energy stocks. So that's the fourth shift I've pointed out to you. I want to show you one more. Let's call this just stocks in general. Versus DBC. So let me just look this up here. So this is all world. This is all world being divided by the commodity complex. So if the line is going higher, it means all the stocks in the world are outperforming the commodity complex. So we're taking VT divided by the commodity complex. And you can see the exact same thing here. I mean, look at this battle line right here. That is pretty incredible. So the strength doesn't mean stocks are falling. I said at the top of this video, this isn't about a crash, but there is a shift in leadership happening all over sectors and slices and segments of the market, and even which asset classes are leading. So this is literally the stock asset class, because this is all world, being compared against commodities. And you can see all world has broken down. The line has broken down, which means stocks are now underperforming relative to commodities. So we have 5 pretty big shifts going on. And the bigger story is all 5 of these shifts are happening. There's not just one this year. Like sometimes if it's just a shift here or a shift here, that's normal. But there's 5 shifts going on, right? We've gone from growth to value. Okay, we've gone from domestic to international. We've gone from large stocks to small stocks. Okay, we've gone from old world. Okay, or actually, sorry, we've gone from new world tech to old world financials, energy, materials. Pretty boring. Do people buy those anymore? And the 5th one is we've gone from literally stocks to commodities being a lead. Those are 5 really big shifts that are happening at the exact same time. So that's the bigger story, that they're happening at the exact same time. Now, everyone is talking, so I want to bring up commodities. I want to bring up interest rates here. This is a price chart of the yield on the 10-year treasury. And everyone's talking about the yield on the 10-year treasury. So let me just zoom out here just a little bit for you to see this. So first of all, these shifts are big. Now, whether you want to call them by any name, you could call them from growth to value. You could call them from domestic to international. You could call them from large to small. You could call them from new world to old world. You can call it from technology to stodgy. You could call it from stock to commodity. They have a similarity. Things that were underperforming in the past, right? A lot of things that were underperforming in the past, okay, are now outperforming. Same thing with dividend. Dividend stocks were underperforming for a very long time. Now they're outperforming. Again, it's another point of just what was underperforming is now outperforming. Now, by the way, guys, that's a sign of bull market health. So it's very likely this is increasing the chance of if you're in Europe or if you're in the emerging markets, right, or 96% of the world outside the US, this is the start of a bull market for 96% of the world. Okay, for the US, it will be a continuation of a bull market that started in 2009. Either way, stocks, most likely what we're seeing here because of this rotation means they're going higher. Yes, commodities are going to start outperforming. They are outperforming, and it looks like they're going to continue outperforming. Part of the reason all of this shift may be happening is one of the reasons, not the only, but one of the reasons just may be of interest rates here. They may have bottomed in 2020. They may have bottomed in 2020. So here's the yield on the 10-year Treasury. And everyone's freaking out. Everyone's freaking out because the yield's 1.5%. Guys, it was 1.5% a year ago, and back in 16, right? And back in 2012, and 2016, and 2019. It's like, so just chill out, guys. It's called reinflation, not inflation. So the yield on the 10-year is now back above this really important 1.4%. But as you see here, it's just kind of sideways between 3% and 1.4%. So we can't say, no one can say inflation is here until the 10-year yield solidly stays above 3%. And you can see it attempted it in 2018, had that's called a false breakout, right? If you can see it, tried to get above it there. It was a false breakout, and then rates just absolutely crashed. So in the background of all this, we have a reinflation of rates. Now that's really bad for people over the age of 50, like really bad, because most of them have 40 or 50% of their money in bonds. And that means bonds are going to be under some serious pressure. If this is a shift, and if that is a generational bottom, we don't know yet, but if that is a generational bottom, that means everyone over 50, first of all, you don't need to be over 50 to be in bonds, but the majority of people in bonds are over the age of 50. It means they're going to see a significant downward pressure on their total portfolio because they're buying into some old school thought of, this is my age, and if that's my age and I was born in 1960. By the way, I'm not making fun. That's just my over 50 voice. It's a mistake. It's going to hurt them, and they won't know why it's hurting them because they'll be like, but I have half my money in bonds. That's going to be the problem. You want to shift your money to where the growth is, right? So what's going on right now is either happening, like this is, first of all, it is happening right now. The question is, did it happen? Meaning, did this shift fully cement, right? Did growth go to value as a lead? Did domestic go international? Did large now go to small? Did new technology now hand the baton over to old school boring banks, financials, energy? Did stocks hand the baton over to commodities? So far, that shift is happening. The question is, did it happen past tense? But it is happening now, and it's happening over so many different ways of slicing and dicing and segmenting not only the equity, but all asset classes are being affected. So this is absolutely a shift that's going to affect everyone, and everyone under 50. So I pointed out, if you're over the age of 50, you probably have 40 or 50% of your money in bonds. This is absolutely going to hurt you if you don't change your approach. But it's also going to hurt people under the age of 50. I mean, it's going to be a double whammy here, because think of where people's money is if they're under 50. Growth, technology, US domestic, large, tech, new, stock. that's all shifting. So it's literally it's gonna hit the under 50 and it's gonna hit the over 50 badly. Really because people just haven't been taught how to read price charts, how to understand the shift in that mass psychology and go where the money continues to flow. Thanks guys for being in my world. I appreciate it. If you like this video, you're gonna love the other videos I have for you. And please hit the like button. It makes a difference to YouTube, and I appreciate that. And of course, if you have a comment, leave it. I read them all. I reply to them. Thanks for being in my world, and I will see you on the next video. Okay, bye.